Every day, this dog goes to the yard and works hard, digging through the dirt, unearthing bones. Honest, tiring work. And at the end of the week, that hard labor pays off. The dog earns a flat, highly satisfying payout of exactly 100 bones. But before those bones can even be buried in the backyard, 20 of them instantly vanish. Poof, gone. That missing chunk is tax. It is a mandatory requirement to hand over a portion of your earnings to the government. No negotiation allowed. It feels deeply unfair the first time it happens, but every single working dog goes through this exact same loss. It is a universal, inescapable system. So where do the bones go? Take a look at this illustration of the public dog park. The government collects those missing bones to build and maintain the community infrastructure everyone uses. Paved walking paths, animal hospitals, the fire station, that heavily funded stick science lab. None of these communal benefits are free to create. To pay for it all, the government extracts bones in a few different ways. The most common is income tax, which is simply taken directly out of a paycheck before you ever see it. Then there is sales tax, an extra cost added right at the cash register when you buy something. Or property tax, a recurring fee charged every single year just for existing inside a kennel. Without those bones, the paved paths would crumble back into dirt, and the science lab would close. Think of it as a mandatory subscription. You keep the park running so you have a safe place to dig tomorrow. A lot of dogs panic when they hear they have entered a 22% tax bracket. They assume nearly a quarter of everything they earned that year will be taken away. Think of tax brackets like a layered bone lasagna. The large bottom layer, your first 10,000 bones, is tax-free. The middle layer of 40,000 bones is taxed at 12%. Only the specific bones spilling into the top tier hit 22%. Because the system is layered, earning a higher salary always results in taking more bones home. Getting a raise will never cause you to lose money. How you pay depends on how you work. If you work for a company, those bones are automatically deducted, but freelancers have to manually report what they earn, and this leads to the tax return. Once a year, you do the math to compare the bones you actually earned against the bones the government already took. Deductions are work-related expenses that reduce the number of bones the government thinks you earned. Work uniform? Deductible. Tools for your job? Deductible. That squeaky toy you bought because you were bored? Not deductible. Put it back. If you try to hide bones, the government will come sniffing through your backyard. They can take away your favorite kennel, and if you still refuse to pay, they might even put you in the big dog cage. Filing this return gives you the chance to prove exactly how many bones you need to keep. It is your best way to guard your pile and force the government to drop back any bones they shouldn't have taken. Now, wealthy dogs play a very different game. They often avoid high income taxes entirely by simply refusing to take a traditional salary. Instead, they buy assets. They watch the value of those assets grow, and when they finally sell, the profit is taxed as a capital gain, a special category that the government taxes at a significantly lower rate than physical labor. A wealthy dog might even intentionally lose money renting out a kennel. That loss lowers their taxable income today, while they comfortably wait for a massive, lightly taxed payout when they eventually sell the property. And looking at this map of global tax rates, you can see large corporations bypassing the park's fees entirely. Their assets flow away from high-tax countries straight into tiny tropical islands that charge 0%. Everything we just described is technically legal, but mathematically, the system rewards asset ownership far more generously than it rewards honest physical labor. So how do you navigate this? Tip 1. Meticulously track all your work-related expenses year-round to maximize your deductions. Tip 2. If you are self-employed, ruthlessly lock away roughly a third of your earnings before you spend a single bone. Tip 3. Pay a professional accountant. Their insider knowledge of the rules easily pays for the cost of their fee. And finally, never file late. Missing the deadline triggers penalties, and those penalties multiply the bones you owe. Taxes aren't going away, but once you know the rules of the park, you can stop guessing and start keeping more of the bones you worked so hard to dig up.